In the realm of finance and economics, discussions surrounding market crashes are often met with apprehension and fear. However, meet Kevin, a prominent figure in the realm of finance and real estate investment, recently expressed a provocative viewpoint: the necessity of a crash. His argument challenges conventional wisdom and prompts us to reevaluate our understanding of economic cycles and the role of market corrections. In this video, we will delve into Meet Kevin's perspective and explore the reasons behind his assertion that a crash is not only inevitable but also essential for long-term economic health. Meet Kevin, whose real name is Kevin Paffreth, has garnered a substantial following on various social media platforms, particularly YouTube, where he shares insights on real estate, investing, and personal finance. Known for his straightforward and informative content, Meet Kevin's recent video titled, "This is Why We Need a Crash," has sparked widespread discussion and debate within the financial community. At the core of Meet Kevin's argument lies the notion that prolonged periods of economic expansion and market growth inevitably lead to complacency and excesses. He contends that without periodic corrections, markets become overvalued, speculative bubbles form, and unsustainable levels of debt accumulate. While these conditions may fuel short-term prosperity, they sow the seeds of future crises by creating systemic vulnerabilities. To support his assertion, Meet Kevin points to historical precedents, such as the dot-com bubble of the late 1990s and the housing market crash of 2008. In both cases, exuberant optimism and lax regulatory oversight contributed to asset bubbles that eventually burst, triggering significant economic downturns. However, Meet Kevin argues that these downturns, painful as they were, served a crucial function by purging excesses from the system and paving the way for a healthier, more sustainable economic environment. Moreover, Meet Kevin emphasizes the importance of market corrections in reallocating resources and fostering innovation. He argues that during periods of economic downturns, inefficient businesses fail, capital is reallocated to more productive uses, and entrepreneurs are incentivized to innovate and adapt to changing market conditions. In this sense, market crashes serve as a corrective mechanism that clears the path for future growth and prosperity. Furthermore, Meet Kevin contends that the fear of a crash often leads policymakers to pursue short-term fixes that exacerbate long-term problems. For instance, central banks may resort to loose monetary policies, such as lowering interest rates and engaging in quantitative easing, to prop up asset prices and stimulate borrowing. While these measures may provide temporary relief, they can also inflate asset bubbles and create dependencies on cheap credit, setting the stage for even larger crises down the road. In addition to economic arguments, Meet Kevin also highlights the societal implications of prolonged market expansions. He observes that during periods of economic prosperity, wealth inequality tends to widen as asset prices soar, benefiting those who are already affluent while leaving many others behind. Moreover, he argues that the psychological toll of constant economic growth can lead to a culture of materialism and consumerism, where individuals prioritize material wealth over personal well-being and fulfillment. However, while Meet Kevin makes a compelling case for the necessity of a crash, it's essential to acknowledge the human cost associated with economic downturns. Market crashes can inflict significant hardship on individuals and communities, leading to job losses, foreclosures, and financial ruin for many. Moreover, the effects of a crash are often felt disproportionately by marginalized groups who are already vulnerable to economic instability. Furthermore, the severity and duration of market downturns are inherently unpredictable, making it difficult to advocate for a crash as a deliberate policy tool. While periodic corrections may be necessary to prevent the buildup of systemic risks, the goal should be to mitigate their impact and ensure a more equitable distribution of the costs associated with economic downturns. Meet Kevin's provocative assertion that we need a crash challenges conventional wisdom and prompts us to reconsider our assumptions about the role of market corrections in shaping economic outcomes. While market crashes can serve as a necessary corrective mechanism to purge excesses and foster long-term economic resilience, they also entail significant human costs and require careful management to mitigate their impact. As we navigate the complexities of modern finance and economics, it's crucial to maintain a balanced perspective that acknowledges both the benefits and risks associated with market volatility. Thanks for watching, and as always, don't forget to like, share, and subscribe for more thought-provoking content. Until next time, stay curious.